Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back for part two with Jordan of Mining Stock Monkey. If you missed part one, we'll put a link right up here. Be sure to check it out. It'll make a lot more sense if you watch that one first. So without further ado, part two. Okay, Matthias and Animals want to know your opinion on First Majestic Silver.
First Majestic. You look back at their history of cash flow per share, and it's not good. They lose money most years. Now that if I recall correctly, maybe they're a little bit better than Core and Hecla were. But anyway, their cash flow per share isn't good. And they made a huge mistake with Jarrett Canyon, it looks like. Now, maybe they turned that around like they did with Santa Elena, but that's taken a lot longer than they had hoped, and it's taken a lot more money than they had hoped. Now, Ermitaño is performing very well for them, and First Majestic were the ones to take over Gatos, right?
Yes.
Yeah. And they paid a lot for that asset, but I thought their stock was pretty highly valued also. So, and it was a stock transaction, if I recall correctly. I don't know. I don't follow these companies super closely. I follow a handful of companies very, very closely, and then I kind of spend 10% of the rest of my time kind of looking at news of other companies, trying to sniff out other potential good investments. So I'm not one to follow a whole bunch of companies and know a little bit about a lot of a company. So if I make some mistakes, that's why with these. But yeah, so Gatos was a very high margin project, and that's generating a lot of cash. So that probably changes their cash flow per share going forward. That will probably make it so they're at least cash flow positive every year for at least in the near future. I like some of the things they're doing. Like, for example, they're trying to sell a lot of their silver directly to retail instead of selling it to the banks, or instead of selling it to fulfill contracts. Because if more companies did that, well, then I think the market would be less able to short silver, and there would be less artificial basically shorting that's suppressing the price. If all these silver miners sold directly to retail, if at all possible. So they opened up their own mint after starting to sell through other mints that were producing products for them, but those mints couldn't keep up with demand. So I like that they're doing that. I hope that eventually they can sell 100% of their silver directly to retail to keep it out of the hands of banks to fulfill future contracts and things like that. But for the performance of the company, I think Keith Neumeyer is getting paid way too much money. His salary was $4.9 million a year last time I looked. And to get $4.9 million a year to run a company that has basically the stock price has gone nowhere for many, many years. Yeah, there's been ups and downs, of course, but it's by no means a steady trend upwards over time. And it's losing money a lot of years. That just doesn't seem fair to me, even though he's been running the company for a long time. He does own a decent amount of stock. He owns about $20 million worth of stock last time I looked, but I believe that his salary is a lot more important to him than the stock that he owns. And then you look at their G&A, and their G&A is about equal to similar or other companies in the precious metal space that have revenues that are triple what First Majestics are. So I think their G&A is way too high as well. So I don't own it. Yeah, I'm going to look really stupid if the silver price goes up, because I don't know what First Majestic is at today. Let's say it's at $6 a share. If the silver price goes up, yeah, this could be a $15 stock. It could be a $20 stock. It could even be a $50 stock if the silver price goes up enough. But that's generally not the kind of investment that I like to make.
Yeah, yeah. I saw very similar things. with First Majestic. Uh, okay, Real wants to know your thoughts on Equinox Gold after quarter one earnings. Their debt reduction path, still good long-term hold?
Uh, well, so in my newsletter, a couple of times, in a couple newsletters leading up to Q1 earnings, I was saying, hey, Q1 earnings are going to be bad. So be prepared for that. Like, I think it's highly likely that the stock falls on earnings, because historically, Equinox has their lowest production in their first quarter, and then their production ramps up throughout the year. Why is this? Well, first of all, first quarter is when they schedule much of their annual maintenance. So when you have a plant that's down for 30 days of the 90 days or the 91 or 92 days of the first quarter, well, that that affects production a lot. And when production is down, costs are up. So when you can see these patterns happen every year, and you know that this happens, similar thing with Barrick Gold. Barrick, actually, it's now Barrick Mining, but Barrick schedules much of their annual maintenance in quarter one. So every year, you can pretty much know that quarter one is going to be a bad quarter. Now, yeah, so quarter one was not good. The stock price was down, I forget, something like 10% that day. And they drew down $40 million on their credit facility during their quarter, and I thought they were done drawing down their credit facility. I did not expect that was going to happen. But at the same time, they did invest $40 million into Calibre Mining to help Calibre get through any potential deficits they might have while the Equinox Calibre transaction closes. So yeah, they drew down that 40 million, but they also got a $40 million investment in Calibre. And once the transaction closes, that's going to be wiped out. That investment's going to go away, and they're probably going to repay that $40 million. But if you read their MD&A, they also drew down $45 million after quarter end. So between the first quarter and quarter end, they drew down 85 million. So I didn't like to see that. It was not a surprise to see them have a bad quarter of production and have higher costs that quarter. I think the market was really disappointed with Greenstone's performance because they're ramping up this new mine in Canada, this big new Greenstone mine, and production actually fell quite a bit. Production in quarter four was 50 some thousand ounces, and it fell by 10 or 12,000 ounces in quarter one. Now, part of that is because it's their first winter operating up there, and it's cold. They didn't know what was going to go wrong during the winter. So now for next winter, they have better ideas of what they need to do, to insulate stuff, or what they need to do to have less downtime in the cold winter months, and to have the plant running at a higher capacity. They also had some delays in getting some equipment commissioned there. So that's going to be improved over quarter two, but we might not see the results of that until quarter three. Like they're adding a new shovel that should be commissioned in July. That's going to help increase mining rates. So we should see this continue to ramp up throughout the year, Greenstone, and also quarter one tends to be their worst at their other mines as well. But now that this Equinox is buying Calibre, in terms of looking at Equinox's first quarter, you also have to look at Calibre's first quarter. And Calibre, they generated quite a bit of cash. They had all-in sustaining costs that were well below what they were guiding for 2025 as a whole. So we might expect that future quarters for Calibre are a little bit worse. If you annualize Calibre's first quarter productions, that would put them a little bit higher than the high end of their 2025 guidance. So that's a good sign, but I don't think we can count on their following quarters being that good. And Calibre is building a new mine. That's one of the reasons for this business combination. Calibre is building their new Valentine mine in Canada that in phase one should be producing about 200,000 ounces a year when it's in full production. And when Equinox is Greenstone mine is in full production, that should be producing about 400,000 ounces a year. So you have 600,000 ounces coming just from Canada there. And then there's a phase 2 of Valentine that should be coming up shortly thereafter, which would increase it by about another 200,000 ounces. So we could see 800,000 ounces coming from Equinox just in Canada alone from 2 brand new low-cost mines. But Calibre, although they generated quite a bit of cash in the quarter, they had to push back what they're seeing as the first gold pour. Now they're seeing first gold pour at Valentine at the end of Q3, and they also had to increase their capex by another $80 million US. They've had several capex increases throughout this mine build now. But you know what? At the end of the day, the gold price is so much higher than it was. So even though there's been some capex increases and there's been some delays, these mines, they're good operators. They will work out the kinks. It may take time. It will take time. But once these mines are in full production, they're going to be generating a lot of cash. Now, Equinox said in their first quarter conference call that they consider the combined company's core assets to be Greenstone, Equinox's new Greenstone mine, Calibre's new Valentine mine, which are both in Canada, and then Equinox's Castle Mountain project in California. So, and they also said that they've made a lot of progress on permitting at Castle Mountain. So this combined company could be a 1 million ounce producer with just those 3 assets: Equinox or Greenstone, Valentine, phase 1 and 2, and then this Castle Mountain expansion project, which would be about 200,000 low-cost ounces per year. So I actually see them since they're saying those are their core assets, I think they're trying to be a US and Canada focused company going forward, which they will probably get a premium for in the market once they have those assets up and running and they can prove that they are low-cost assets. Greenstone's first quarter, their AISC at Greenstone, did I say Equinox's first quarter, their AISC at Greenstone jumped up to over $1,800 an ounce. So that was a surprise, but their production was so much lower. I think we're going to see those costs come way down. Yeah, overall, I really like the combined company. Tough first quarter. They have a lot of debt between the two companies, long-term debt, short-term debt, gold prepays. Calibre also brings a lot of debt to the table. Calibre has a better balance sheet between the two, but they're by no means in great shape balance sheet wise. And between the two companies, there's like $2.5 billion of debt, long-term, short-term, and gold prepay liabilities combined. So there's a lot of debt there. They're probably going to be selling off non-core assets to help pay down that debt really quickly. But I think as those Canadian mines get into production and ramp up, well, then we're going to see a big change in the share price upwards. So I like it right now. I like both Calibre and Equinox. When I did the calculations yesterday, Calibre was a slightly better buy between the two based on the how many Equinox shares you would be getting if this transaction closes, which I think is highly likely.
Okay. I like them as well. I bought more today. Okay, let's see. Berlin wants to know, he's asking about geopolitical risk. He says, is the risk in Burkina Faso increasing and outweighing the benefit in companies like West African Resources and Endeavour Mining?
Oh, Burkina Faso, where do I even start? So there's a jihadist insurgency right now that's connected to Al Qaeda, and they control about 40% of the land there. It was reported that Burkina Faso nationalized 2 of Endeavour's mines. That's how it was reported in Western media, but it wasn't really like that because, yeah, they had a pending sale with another company that fell through for reasons like I think the other company was saying that there were things about the assets that they weren't aware of, and or something along those lines. So they were selling these 2 mines in Burkina Faso to this other company, and it was falling through, and they were trying to come to some sort of resolution, and during that time, while they were trying to come to some sort of resolution, the fighting in that part of the country had increased a lot. So that devalued the assets by quite a bit. Now, the Burkina Faso government ended up coming in there and being like, "Hey, we'll buy them from you. We'll buy these assets from you. You can settle this. We'll give you, yeah, you were going to sell it for 300 million, but we'll give you $80 million plus a big royalty." And I think maybe they'd received something already. So they ended up receiving about half of what they were going to receive from this other company before this dispute started. And this was reported by Western media as a nationalization of these mines. And that scared a lot of investors. Yeah, technically it was nationalization because it was Burkina Faso government buying the mines, but it was by no means expropriation. Maybe they didn't get as good of a price as they had hoped, but the value of those mines had decreased a lot since the fighting in that part of the country, or that part of the country, had become so much more unstable since those negotiations had started. So there's things like that that are reported in weird ways that I think make investors more scared than they should be. Now we've seen countries exit Burkina Faso because of the instability there. For example, we recently saw Fortuna Mining sell their Yaramoko mine, and they were spending $7 million a year just on security, just to try to defend their mine from what was going on and defend shipments of the gold and things like that. Now, one big thing about Burkina Faso is, and you see this in Western Africa in general, is these West African countries are trying to get a bigger take of the mine. And so I don't follow West African resources, but I do follow Endeavour Mining very closely. And they have 5 operating mines, and they're going to be building their 6th one pretty soon. And they have 2 of their 5 mines in Burkina Faso. Now, one of those 2 mines isn't very important to the company. So one of those is their shortest reserve life and their highest cost mine. So that one's not very important to the company. So of their 4 important mines, 1 is in Burkina Faso. And Burkina Faso, like the other West African countries, they want a higher share of the amount of cash that these mines generate. And so I believe, if I recall correctly off the top of my head, of those two mines that Endeavour has there, their taxes and royalty rates and such are going to increase when their permit renews. And their permit renews in 2027 on one mine and 2029 on another mine, if I recall correctly. So in a couple of years, yeah, they will be paying some higher taxes, and in 4 more years, they'll be paying some higher taxes. Now, because of the instability in Burkina Faso right now, they're focusing their investments in other more stable West African countries, like their new Asafo project that they're probably going to be declaring construction here on in about a year or so. That's in Cote d'Ivoire, if I recall correctly. So lots of stuff going on in Burkina Faso. Now, I'm not trying to say by any means that there's no risk there. There is. I mean, when you have these jihadist insurgencies and the government's trying to fight them off, and there's these coup attempts, and I think the government came into power from a coup, which is pretty common in West Africa. Yeah, I mean, it's not the friendliest place to do business, but because it's not, you can typically buy the companies at a big discount to, for example, North American counterparts, or for just about any company for that matter. But there's a lot of benefits to operating in West Africa. Your discovery costs are way lower. Your time from discovery to production, instead of taking 25 years, you might get into production in 8 years from first discovery. So when you get into production in 8 years versus 25 years, that helps out the net present value of that a whole heck of a lot, even if the government does take a higher percentage of the taxes or a higher percentage of the earnings once you are in production. But President Traoré in 2024, he made some comments that kind of scared investors in Burkina Faso. And he had made comments that talked about taking away the mining licenses of some Western companies operating there. But this was in a context of this was like one sentence in a context of a hour-long interview. And I think a lot of it is appealing to his political base and not so much a serious threat. And also he was talking about companies that weren't in compliance with Burkina Faso's new mining code. Endeavour Mining, the first company to be compliant with Burkina Faso's new mining code. So even if he is talking about taking away mining permits, I mean, that shouldn't apply to Endeavour. What else? Increased Russian influence there. So you have the Sahel states. You have Burkina Faso, Niger, and Mali. Those are what's referred to as the Alliance of Sahel States, or abbreviated as ASS. And the Alliance of Sahel States, before, not too long ago, they were using French armed forces. And there's a long history of having French influence there, or if you like, Western influence. Well, they're not so much using French armed forces for security anymore, and they're more so using Russian armed forces. They're using the Wagner group from Russia. So there's more ties that are coming in with like Eastern countries, or like stronger ties to Russia versus stronger ties to the Western countries. So that makes some investors nervous. And with what happened a few years ago, it should make investors a little bit more nervous. Now, I think Trump is trying to repair some of those relations with Russia. So maybe that's going to make things better for investors who are Western investors investing in countries with Russian influence. But it's not just the Wagner group that's there. Also, like, it was just last month in April that Burkina Faso granted a mining permit to Russia's Nordgold there. So there's also Russian ties in that way. So you see some signs that they're leaning more towards like siding with Russia rather than France, for example. So, I mean, that's kind of my take on it. Endeavour Mining, it was trading super cheap. I added that to the portfolio in December when it was $18 a share or so, and it just shot straight up. And then it was at $30 recently. I think it sold off a little bit. Now it's $27 or $28 US dollars per share. But it was stupid cheap. Now it's very cheap, not stupid cheap. But yeah, I like Endeavour a lot, and they're very good operators.
Okay. And you understand African risk in Burkina Faso.
I try to. It takes a lot of research to understand this. And yeah, I'm not writing a newsletter every day. I try to update subscribers about once a week, but all my working hours are spent doing this. It's spent on research and figuring out this, so I can talk off the top of my head about things like this and know all these little details about these companies, because like to have a real advantage in this game, or to have as much of an advantage as possible, you want to know as much as possible about it. So
Okay, that makes sense. Some other questions we got here. What are some red flags that allow you to eliminate a company quickly?
if it's a producer and you look back on their history and they have a history of just really bad cash flow per share, you can have an idea very quickly if they're if they have a good history of making good decisions. So, for example, a great website to do this is Ticker, TIKR.com. You can go in there, you can find their cash flow per share and just look at a chart of the last 20 or 25 years. This is a way to find this in 30 seconds. And if you see that it's a negative almost every year, or they're making very little cash flow per share, that's a good sign that it's just not a well-run company. Another thing is if management doesn't own any stock or they don't own much stock, if management doesn't have skin in the game, why do you think the stock price is going to go up if it's not important to them? And what else? So early last year, we saw, or maybe it was mid 2024, we saw a catastrophic failure by Victoria Gold. Now, although I didn't know that this was coming, I didn't know that their tailings facility was going to collapse by any means, they were at higher risk. Why were they at higher risk? So a lot of investors bought into Victoria because it was a gold company, it was a gold producer. They were producing gold and they were in a safe jurisdiction. So people thought there wasn't much risk there. But I think there was a lot of risk there. Why? Because they're a single asset producer. You look at their balance sheet, they had a lot of debt and they didn't have much cash. So they had a lot of debt that they had to pay off, and they were dependent on that one asset to pay it off.
Yeah.
And then a third factor about that, they had that one asset was a relatively high cost mine. It produced ounces at a relatively high AISC. So those three things, that should scream risky stock when you see these. And if you see that, maybe they're cutting corners somewhere because they know they have to pay down that debt, and they know they're dependent on this cash flow to pay down that debt. So maybe they weren't properly monitoring their tailings facility, or maybe they're cutting corners in the construction of that, or maybe they're stacking it too high. All sorts of things like that. That maybe risk factors like single asset producer with a high cost mine with like a lot of debt on the balance sheet and not much cash. Maybe there's other hidden risks there that you don't know about, and you're never going to know about until they happen. So that's something to think about. Maybe even if it's cheap, maybe it's cheap for a reason.
Okay. So if they have a history of making good decisions, you can go to tikr.com for that. We want to see that management owns a lot of their own stock, or else they don't have any skin in the game and they're not aligned with you. And pay attention to single asset producers, because that could be dangerous.
In particular, ones with high cost mines and ones with a stretched balance sheet. There's others that have just one producing asset, like the G Mining, for example. They have a good balance sheet, and they have low cost mines, and they're building another low cost mine. So
Yeah, yeah. Or Silver Crest before it got taken over. Okay. What are some of the key things you look for when deciding to invest in a company?
well, is the commodity cheap? That's really good. If the commodity is cheap historically, low prices cure low prices. So if commodity price is low, it's probably going to go up. And when the commodity price goes up, the company makes a lot more money. And price to value. If you're able to put a realistic number on the company's value, and you should be able to do this if you know the company well enough to buy it. Like if you're reading before you buy a stock, you go back and you read like the last 6 quarterly reports, for example, and maybe like the last 5 annual reports. That's going to take you a couple of weeks, but you're going to know the company very, very well, better than 99% of the market does. And you should, by doing that, be able to have some type of idea of the company's value. And then when you have an idea of the company's value, the price information, the stock price, has meaning. Because then if the stock price, or well, the market cap or the enterprise value is below the company's fair value, well, then perhaps it's a good buy. Or if it's far enough below the fair value, maybe you want a little bit of a margin of safety there. in case you're wrong about something or in case something bad happens. And then if the price is above the fair value, or maybe even if it's at fair value, it's not cheap enough and you want to wait. Something else I look for is, does management have a history of making shareholders money? We talked about, maybe this is going to be in part 1 of this video and this is part 2, but we talked about Equinox Gold and Ross Beatty. He's a big investor in Equinox Gold, and this is his baby. And he's the chairman, and he has a very long history of making investors lots and lots of money. And when people have a history of doing that, they're probably going to make investors lots of money again. Now, same goes for some other people, like if you have a Lundin company, if you see the Lundins running a company, that's a very good sign that investors are going to make money in that stock. But a lot of times you have to be patient. Even if it's a Ross Beatty company, or even if it's a Lundin company, you can look awfully stupid 5 years later when your investment is down 75%. But when your investment is down 75%, that's probably when you need to look at seriously increasing your position. And if you don't understand the company extremely well, you're probably not going to have that mental strength and that conviction of your knowledge to be able to double down or triple down or quadruple down on that stock when your portfolio is down 75%. So that's where knowing the company inside and out is invaluable, because it allows you to stay the trade and it allows you to make those big investments when it's the absolute most important. So there's some Lundin companies that I would love to buy today, but I'm just hoping that if I'm patient, that we're going to see a 75% drawdown on those, or 50% drawdown. I'll be able to enter those at a much lower price when the investors get bored with it and they forget how good the Lundins are at creating value.
Okay.
Well, sorry, what was the question?
It was key things to look for when deciding to invest in a company, and
Oh
basically,
yeah, I was talking about
commodity,
management.
price to value, and does management have a history of making investors money? That's those are your top 3 there.
And
Okay,
do they have a significant stake in the company? But we talked about that earlier.
yeah, and what commodity do you think is most unappreciated by retail investors right now?
Platinum and palladium.
Oh, I didn't expect that. Okay.
But it's so hard to find a quality platinum and palladium play that's outside of Russia or South Africa.
Yeah. Yep.
So
Well, I don't
it's
think they're
tough.
already. That's why. I'm just playing the metal itself. I figure that's got enough leverage. If I'm right, it should be at least a double, but we'll see.
Yeah, and you have the Sprott Platinum and Palladium Trust. You want to buy that if you're a U.S. investor in a tax-free account or a tax-deferred account like a 401k or a Roth IRA or something like that, because it is considered a passive foreign investment company. And those have some serious tax consequences if you own them in a brokerage account.
Okay. So you could get a double, but then you get taxed so much it doesn't feel like it at all.
Yeah. Steve, you could literally get a double, and then because of those massive taxes, if you don't do the proper filings of those PFIC elections, you could literally lose your entire gain.
That's
So
awful. Okay. That might be the most valuable thing that that we learned from this. Oh, that's so true. Uncle Sam always gets his. He always gets his. All right. How would you weigh geopolitical risk in your mining stock assessments, particularly with regions like Africa or South America?
I think it's on a lot of times on a case-by-case basis, and those companies operating in what investors perceive as a safe jurisdiction get a big premium. Now, if you talk to Brian Dalton, CEO of Altius Minerals, I think he would tell you that Canada is an extremely risky jurisdiction because Alberta, the province of Alberta, effectively stole their coal royalties. Just a few years ago, their coal royalties were expropriated from them. So, I mean, as an Altius investor, I would say Canada can be quite risky. And then when it comes to getting a project permitted in Canada, well, then, I mean, that can be very risky as well. And it can take a long time, and that those many years it can take to get permitted can cut the net present value of that deposit by quite a bit. Whereas like in West Africa, yeah, that you can permit them a lot faster. Yes, you're dealing with other risks, but to say there's no expropriation in Canada is just ignorance, because there is. It's just that they do it in a way that the population seems to be okay with it. Like Altius getting their coal royalties expropriated was because Alberta changed their law, and that coal power plant had to be converted from coal to, I believe it was natural gas. And Altius had bought coal royalties on these coal deposits near that plant that were effectively expropriated for them because of the change in the law. And then they took that to court, and then they lost. And then they appealed that in court, and they lost. The operators of those coal mines got compensated, but the royalty holder did not. And to me, that's just as much an expropriation as somebody going in and stealing your mine with guns in Burkina Faso. It's just done by white people through the rule of law, as Rick Rule would say.
Yeah, it's still government stealing either way. It's both theft. Okay, what is one lesson you wish you'd learned earlier in your investing journey?
Well, you actually touched on this in part one, but press releases are sales pitches. Don't look at press releases as news. I mean, you need to view press releases, and you need to consume them immediately, but you have to view it through the lens of this being a sales pitch of the management team trying to get you to buy their stock. And when you can view it through that lens, it allows you to understand when it's news and when it's them sugarcoating things. And it allows you to understand when to dig deeper and when to figure out what the real truth is behind that. Another lesson is that high prices cure high prices. So as a value investor, when I started in investing in natural resources, I was attracted by low price to earnings ratios. And the thing is, low price to earnings ratios, when it comes to resource stocks, is often the worst time to buy, because low price to earnings ratios are usually happening because the earnings are so high because the commodity price is so high. And the commodity price being so high, it is bound to fall. So for example, a few years ago, I think it was back in 2022, a lot of people were really attracted to the platinum and palladium miners because they were trading at PE ratios of 3 or 4. But the commodity prices were so high. The rhodium price had shot up to $20,000 an ounce or something.
Yeah.
The platinum price, or the palladium price, was something like $3,000 an ounce. I think the platinum price was a lot higher than it is now. And those earnings collapsed when the platinum and palladium and rhodium prices collapsed, which was inevitable. So remember, high prices cure high prices, and that usually a low PE ratio is a bad time to buy. Whereas in the broad general market, usually it's a good time to buy, but it's the opposite in resource stocks. And oftentimes when it's the PE ratio is negative, that can be a good time to buy, because that's when the commodity price is so low that the miners aren't making any money, and the stock prices are so low, and the commodity price is bound to turn around, which is going to totally change the earnings and totally change that PE. Yeah, that's a couple of lessons. I'm sure I could come up with a couple of others if I had a couple minutes to think about it.
That's a good one. Press releases or sales pitches, high prices, cure high prices, and I'm glad you brought up that low PE ratio, because that's something that people just glance at and be like, "Oh, it's a good deal." Well, not necessarily. Gold's pretty expensive right now in comparison, so that could drive down the PE ratios. Okay, wrapping up here, what's a misconception you see all the time in the junior mining space that you'd love to debunk?
Yeah, this is the reason why long-term investors in the big royalty and streaming companies have done so well. And that is because the markets value the long-term, or the value of a royalty or a stream on a mine, a producing mine that has a really long mine life, that's producing at a low cost for the mining company. What the traditional way to value this is, just like with a traditional NPV model. And this is so wrong. The investors get this so wrong, and they keep doing it. So what they're going to do is they're typically going to look at, okay, what's production going to be going forward? What is this mining company telling us that their production is going to be going forward? What has their feasibility studies shown that these production levels are going to be in these years? And then we're going to take this and we're going to apply our royalty or our stream percentage, and we're going to subtract, if it's an NSR, we're going to subtract the things that are subtracted from that, like the transportation cost, the smelting cost, insurance during transport, and things like that. And we're going to assume the commodity price going forward based on what, like, the futures are saying, or based on the consensus commodity price or something like that. And we're going to assume that going 10 years out, going 20 years out. First of all, that's a big mistake, but they're making a whole series of mistakes when they're developing this model. And then they take that and they look at the cash flows that are coming in each year. And they see, okay, there's going to be $2 billion worth of cash flows coming in based on these commodity price assumptions, based on these production assumptions, and based on like this, yeah, based on the current known reserves, because that's what we already know about. And then they take those annual cash flow numbers and then they discount them back to today using some sort of discount method like NPV5 or NPV8 or NPV10. And that's probably going to vary depending on how high quality the asset is, where the asset's located, if it's in what's considered a safe jurisdiction, if it's what's considered a risky jurisdiction, if it's a low-cost mine, if it's a high-cost mine, things like that. And that's how they create the net present value of this royalty. But that is so wrong. The value that puts on that royalty so far understates the actual long-term value of that royalty that it's not even funny. They're not even close, yet they keep doing it. And people keep using this valuation model. So how should they value royalty on a long life tier 1 low cost asset? Well, first of all, they should not assume that the current reserves are going to be the reserves forever, because on a tier 1 mine, there's always good surprises. And when it's a low cost mine, when the operator operates it at a low cost, they're making a lot of money. Those exploration teams get all the budget they want to explore. So they find a lot more ounces of gold or a lot more pounds of copper or whatever it is they're looking for. They're almost inevitably going to find a whole heck of a lot more than that. And maybe that mine has a 15-year mine life today or a 20-year mine life today, but when it comes down to it, that mine is going to be operating for 50 years or 100 years, or maybe even longer. So and when you increase reserves over time, you also have to assume that the mining company is going to increase production over time. Because as they increase reserves on these low-cost mines, they're going to do the calculations, they're going to run the studies, and they're going to find that, hey, if we make an additional $3 billion investment, that's going to improve the NPV of our mine by a lot. And then the royalty holder gets all that benefit for free because it moves their royalty ounces forward or their royalty pounds forward, and it improves those NPV models. But the analyst or many investors aren't going to take that additional production into account until the mining company says we're expanding production. But that's a mistake. You have to assume expanded production over time. Now, maybe you think, okay, this mine will be producing at 5 times the rate it's producing at 20 years from now. But to be on the safe side, I'm just going to assume that it's going to be producing at double the rate. So you can still be conservative in these estimates. And like, let's say you're valuing a long life gold royalty. Well, over the past 20 years, or 25 years, the gold price has increased on average 9% per year compounded. I mean, this was 7% per year before the big run up, but now that we've had a big run up, now it's more like 9% or so. Now, if the metals price tends to go up over time, in your NPV calculations, why will you use a $2,800 gold price for decades into the future? Or why would you even use today's gold price? Let's say today's gold price, I haven't looked, but let's say it's 3,300. That doesn't make sense. So when you're looking at cash flow 20 years into the future, you've got to assume the commodity price is going to be higher. Yeah, there's going to be ups and downs along the way, but if you look at a long-term chart of gold, it goes like this, from the lower left to the upper right, with some ups and downs along the way. If you look at a long-term price chart of copper, it's the same thing. So you have to assume a higher commodity price when trying to calculate the net present value of future cash flows. Now, maybe if the gold price has increased 9% compounded for the last 25 years, maybe you don't use 9%. Like we were conservative using the increased production levels. Maybe we're conservative and we assume a 2% annual increase in the gold price or a 3% annual increase in the gold price. And then it's only after you assume higher reserves, you assume production increases over time, and you assume a higher metals price over time, adjusting the metals price a little bit each year. Then, only then, can you run a traditional NPV model to calculate a fair net present value today on a royalty or a stream on a long life tier 1 low cost asset. But I mean, this is pretty simple stuff. If you just think about it, if you think about why investors have gotten this wrong for so long, but nobody does this, or very few people do this.
Okay, so basically, for calculating the value on this, on a royalty like a long life, low cost asset, you've got to assume that the commodity price is going to go up because that's what usually happens. You got to assume that they're going to find more reserves. In other words, the size of the prize will get bigger. And you also got to assume that as they mine this out, they're going to get better at it and production is going to increase. So you got to calculate that into your NPV calculations.
Yes, and I forgot there's one other thing you have to assume, because I'm going to run my personal NPV models doing something like that. But I also have to assume that the market will continue using their same stupid NPV models that they've been using in the past, that will continue to get it wrong. And I have to be a long-term holder of that stock, whatever stock it is. Like, let's just say it's EMX Royalty, because I ran a similar NPV model on the value of their royalty on Timok in Serbia. And even though my NPV model is worth multiples of the current stock price, despite them having lots of other assets and lots of other producing assets and exploration assets and tons of other royalties, I think that one asset is worth way more than the company's market cap today. But I also have to realize that the market is not going to recognize that for years, until the operator says, hey, we're expanding production, until the copper price is $7 instead of $4. Because it's going to go up over time. The mining costs go up over time. It's been going up for a very long time. It's going to continue going up. Yeah, there will be ups and downs along the way, but you can't assume a flat copper price. But yeah, the market isn't going to make those adjustments to their net present value models until they see those additional reserves, until they see the operator expand production, until they see those higher copper prices. They're all inevitable. They're all going to happen when it's a long life, low cost asset. So why not price it into your model? I think it's stupid not to. But yeah, it's value that's slowly going to be realized by the market over time. And those people who do these calculations that I'm doing today are going to be handsomely rewarded when they hold that stock for a couple of decades.
All right, Jordan, I got to give a shout out to your newsletter. It's my favorite newsletter. I'm a part of 6 paid newsletters, and yours is by far my favorite. You get about 1 email a week. You break down the model portfolio, why we're invested in these companies, and any possible catalysts coming up for them. Go ahead and give viewers what they can expect if they sign up with your newsletter.
Yeah, basically you're getting access to my very best research, and I'm doing this full time. Watching these interviews, I hope you can see how well I know these companies. I know these companies like the back of my hand. I try to follow every tiny detail like them. So sometimes we can know stuff before most of the market knows stuff, and those opportunities can be extremely profitable for us. But in the newsletter, you get to know what I'm buying or selling with my own money. And when I add a new stock to the portfolio, you get to buy it before I do. And when I decide to sell a stock in the portfolio, you have an opportunity to sell before I do. So you're always assured that my interests align with your interest. And I do not accept any money. There's some newsletters out there who accept money from companies to be promoted in their newsletter. And you'll see this where it's like pages and pages and pages saying how great the stock is. And then it's small print at the very bottom. It will say, by the way, we were paid $100,000 by this company for this promotion. And in cases like that, these can be very popular newsletters, but their interests aren't aligned with yours. But nobody can pay me. No company can pay me for my promotion in the newsletter. So you're always assured that it's because I've done the research to think that it's a good investment. I don't always get things right, but I work damn hard to make sure I get as much stuff right as I possibly can. And you get to learn basically the most important stuff that I learn.
Yeah, it's an amazing newsletter, Jordan. I highly, highly recommend it.
And for anyone watching this, I am offering a 10% discount to the first 75 people, but I think this is going to be part 2 of the interview. So it's highly likely that most of these spots are already taken. Maybe there's not a single one left, but anyway, if there are, it's just click on the link down in the description or comments below.
Yes. Thank you, Jordan. This was a pleasure as always. You have a wonderful rest of the day.
Hey, thanks, Steve. You too.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.